Good morning and welcome back to Almus Market Mornings. President Trump has granted automakers a 1 month exemption from new tariffs on Mexico and Canada, with potential relief for agricultural products also in the works. Beyond tariffs, markets are reeling from volatility. European bonds took a hit, with the 10-year yields across multiple EU countries jumping over 25 basis points. The dollar index has dropped more than 3% since Monday, while the euro and Asian currencies have gained significant ground. JK, how do you see these market swings playing out?
Hi, good morning, Raj. I think this is one of the uh, most volatile weeks, or rather, I would say one of the largest moves that we have seen in the week today so far. We are only 3 days into the week, and we have 2 more days to go with a lot of data coming in. And this has also happened, without too much data also in the last 3 days, but everything is based on news, announcements, and all that. What I observe also, how perceptions can change the directions of the markets is what I'm looking at. Now, just to give you a instance, initially when the Trump administration came to power and they talked about tariffs across nations and particularly against Canada, Mexico, and all that, it was thought to be highly inflationary. The yields would go up, and then dollar will be strong, even stronger. That is how the perception was. But as things have evolved, not only is there some sort of a negotiable route available for the tariffs, but also even the tariffs themselves, if they are implemented, how it would impact the US economy negatively going forward, and bring down the US exceptionalism, is how the perception has changed, and that is one of the reasons why the dollar has actually been lower. We can see that a lot of data and surveys particularly have shown the forward looking perception on the US economy is definitely drifting lower, and one of the reasons is the tariff themselves. And as I shared yesterday, the GDP now tracker is putting the quarter 1 GDP at minus 2.3%. And let me quote also what Treasury Secretary Besant had replied when he was asked by a reporter if US was in a recession. He was saying that we are seeing a hangover from excess spending in the last 4 years, and in the 6 to 12 months, it is going to be a bumpy economy. So it's very clear how the perception have changed, and that is really how the US dollar has reacted, US market has reacted, and perception about the US economy itself has changed. Another concept that we have noted in the recent days is there is whatever it takes moment that has arrived again in Europe. If you remember, in 2012, Mario Draghi, the then president of ECB, did coin this term, whatever it takes, to save the uh, region from the sovereign debt crisis, and he did unprecedented measures, and that actually shored up the region's credit. Now, recently we have seen how the European economy has been weakening, without investments, and the surveys have pointed out a very weak sentiment as well. And there was a political problem, in major countries like Germany and France. But the recent decision of US to stop funding any defense on the eurozone, on the Europe for their security, and also for supporting the Ukraine war, has actually pushed Europe into a corner, and then that has brought up all the political parties together. And now we are seeing whatever it takes, 2.0, that is being taken by Germany, and they have actually moved forward to achieve a debt break. What the debt break is, that Germany has a fiscal rule which doesn't permit them to have a deficit of more than 0.35%. We have a rate of 0.35%, which is in the excess of 3% almost in all the countries. In US it is over 6%, in India it is 4.8%. So that is the kind of fiscal tightness that they have been following, and now they have opened up the purse, and they're going to spend as much as $1 trillion. This is the moment that the German government has come up with a huge solution. It's also a big relief for the other nations in the zone also, because when Germany loosens the fiscal, it is also going to participate in the common bond, and that will help the debt in the other countries as well. Of course, we did have a huge move in the German yields, moving as much as 25 basis points in a single day. The borrowing cost in Germany has shot up. As you said, the euro has risen by 3% in the last 3-4 days. Euro breaking successively big resistance levels and trading as high as 1.08 as well. In the meantime, even the European markets have been performing exceedingly well. Two, one is the defense sector doing well, obviously. Secondly, on the perception that the economy is going to get a big bump up. And so that also leading to the stock market doing well. So that's how the scenario has changed. Of course, in the midst of all this, ECB is expected to cut interest rate today when they meet to prop up the economy. But then, with the kind of outlook for the eurozone economy kind of changing, and also the impact of the higher fiscal spending, there may be a question mark about how far they will go on cutting interest rates. Even the next meeting itself, it will be not so sure as it was in the earlier time. At the same time, as we have shared yesterday, also in the US, there is a perception that there will be three rate cuts this year as against one that was being expected earlier. So this differential, in the monetary policy expectation as well as the actual move down in the rate differential between Germany and Europe and US has actually also added to the euro's strength that we are seeing. So overall, as you said, the dollar has been weak. Even the other currencies have gained, not just following the euro, but also because of the softness in the US economy. Yesterday, there was more evidence when the GDP private payroll data came at a meager 77,000 versus 186,000 in the last month, and then 140,000 that was being expected. And this actually is a precursor to the unemployment report that we will have on Friday, which is expected to be weak anyway. There was some relief in the ISM services report, which stabilized and saw most of the components actually improving. There was a concern that this could also be a weaker number going by what we had seen in the last month. So this and the announcement that US will be postponing some of the tariffs for Canada and Mexico, particularly in the auto sector, actually gave a relief to the US stock market, which ended positive. Otherwise, they have been on the losing streak. And even the US yields also recovered from the lows to some extent. Of course, also drawing inspiration from the big rise in the German yields. Now, don't forget that the whatever it takes has actually been percolating to the other regions as well. I am seeing this, even RBI adopting this, because the central bank yesterday announced another bazooka of liquidity of 1.87 lakh crore rupees, thus taking the total easing measures to a staggering, unprecedented 4.7 lakh crores in the last 2 months. And this is really historic, and it can be likened to what Europe has done. Definitely, central bank has done this preemptively to infuse so much liquidity into the system that the economy, either at the macro or the micro level, does not get into any sort of crisis situation. Don't forget that this is a fiscal year end month also, and with a lot of outflows expected, government spending actually slowing down, economy slowing down, meltdown in the stock market, leading to the portfolios of people, reducing, and then liquidity tightness being pursued. I think this is one of the most boldest step that the central bank has taken to see to avert any sort of crisis or difficult situation that the markets or the economy could get into, particularly in a fiscal year ending month. They were actually already taken the bold step of cutting repo rate at, by 0.25% last month, and much against the expectation of many analysts, and CRR was also cut earlier. So I think all in all, I think the central bank has done a tremendous job by averting any sort of difficulty the economy could face due to the global as well as the domestic factors. The only question that remains is how far the FIS are going to be selling, because that is one of the reasons why we are seeing the liquidity shortage as well. And yes, I think perception is that we are somewhere close to at least a near-term bottom in the market, and could be value buy that can come eventually, particularly in the light of the fact that US yields are coming down and US rates are going to go down more than what it was perceived to be earlier, and this can lead to more money flowing into EMs, and India cannot be left behind in this. I think it's only a matter of time before we see a turn in the FII flows, and as well as rupee, which is already started to respond to the dollar index, which has fallen. RER must have corrected much more right now, and of course the year-end flows also normally supports the rupee to be stronger. So looking at rupee slightly in a lower range between 86.30 and 87.20. Thank you.
Thank you, JK. And I think the key theme which is going on in the markets is it is not just the US exceptionalism waning, because recently we have been seeing weaker data from the US, but also other economies propping up and stepping up to boost their markets. We have the European markets, which are, with leading with Germany announcing some fiscal deficit breaks so that they can spend more. Given how the US also has positioned itself geopolitically, now we have also our own central bank, which has announced another large chunk of liquidity infusions, large buy-sell swaps. I think another $10 billion and OMO bond purchases. So, a lot of monetary stimulus measures being undertaken by RBI to relieve from the liquidity pressures. And as JK mentioned, there could be a turn in the FIF flows, and rupee has already started reacting to lower DXY. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.